Hey guys, I wanted to put out a video. So we are not meeting for class on Tuesday, February 16th. It remains to be seen if we will meet for class Thursday, the 18th. Looks like we're going to get some more snow Wednesday and then also Thursday. So if I were to guess, I would say that we will be virtual all week. But as of right now, all we know is that tomorrow, Tuesday, we will not meet for class. So I'm going to go over objectives 1 and 2 in chapter 9. There are still people that have not taken our test. So until that happens, I can't go over the test and what you guys were confused on and didn't get right. So know that we will do that at a future date. But right now, I want to start chapter 9. So chapter 9 is on receivables. Okay. In the past, we have only talked about accounts receivable, but we're going to introduce different types of receivables in this chapter, how companies treat them, how they view them, and the accounting behind them. Okay, so what we're going to try and do today during this lecture is go over a lot of the groundwork, and then we will save next week for most of the problems and the formulas that we use. So one thing that I noticed on our test and one thing that I want to talk about in class is I want to spend more time on the formulas because I feel like that was where some of you guys missed some questions. So if we need to take things a little slower, we can definitely do that, because I want us to make sure that we understand the formulas that are needed to solve the homework problems and to solve questions on the test. Okay, and so next week when we get into those formulas that surround receivables, we're going to spend a lot of time on those, and we're going to dig down and make sure that we understand how to solve those things. Okay. So for this chapter, so for today, I'm going to cover objectives 1 and 2. So we're going to look at receivables, the 3 different types, and then we're going to describe uncollectible receivables, what that means, how companies account for it. And then next week we'll look at the different methods for writing off those things, but we don't want to get ahead of ourselves. So when we think about receivables, so an account receivable is the receivable that we looked at all first semester in Principles 1. A receivable is an asset. It has a normal debit balance. So if we were going to record a receivable, we would debit accounts receivable. And any time that we mentioned accounts receivable, what happened to cause us to debit accounts receivable would be that a customer came in and purchased something on account. So instead of them paying us cash, they paid us on credit. And we extended them credit in hopes that at a future date, they would come in and pay us in cash. They just didn't pay in cash that day. All right, so when we look at 9-1, classification of receivables. So the receivables that result from sales on account, which is what we just said, are normally accounts receivable or notes receivable. The term receivables includes all money claims against other entities, including people, companies, and other organizations. And receivables are usually a significant portion of the total current assets. So we've said in class, if you had a business and the only way that you allow customers to buy goods was by cash, it's potential that you would do well, but you would be leaving out lots of customers who don't carry around cash, who choose not to use their cash to buy things and instead prefer to buy things on credit and pay them off at the end of the month or pay them off at a future date. So by companies allowing customers to purchase things on credit, they open themselves up to risk, but at the same time, they open themselves up to additional sales that they wouldn't get otherwise. So we're going to look at 3 different types of receivables. So there are accounts receivable, which is the most common version of a receivable. This is just a traditional, a customer comes in and wants to buy something. They buy it on credit, and An account receivable is usually 30 to 60 days that gives the customer that amount of time to come in and pay that balance off in cash. Okay, so the most common transaction creating a receivable is selling merchandise or services on account. Okay. Obviously, when you do that, we record a debit to accounts receivable, which is a promise from that customer to pay us in cash within a certain amount of time, normally 30 to 60 days. And remember, accounts receivables, they're always current assets because we expect that to transition into cash within 30 to 60 days. Okay, now another version, what we're going to look at in this chapter, is called a note receivable. And a note receivable is a lot like accounts receivable. It's just a more formal agreement. Normally there's paperwork that needs to be signed. There are interest rates that are usually incurred if you extend a note receivable to a customer, and they have the potential to be longer than an account receivable. All right, so it says notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued, which means you sign a sheet of paper that says, hey, I owe this vendor a certain amount of money. I have 6 months to a year to pay it off, but I'm going to pay a certain interest rate to get this extended period of time. So if notes receivable are expected to be collected within a year, they're classified on the balance sheet as a current asset. All right, so it says notes are often used for credit periods of more than 60 days. So remember, accounts receivable cover 30 to 60 days. If it extends past 60 days, normally a business wants to receive some interest for extending that time out. Okay, so for example, a seller may require a down payment at the time of sale and accept a note or a series of notes for the remainder. Such notes usually provide for monthly payments. So whenever you go and you buy a car, you pay a certain amount of money down, and then you have a car note that you pay on each month for 36, 48, 60 months, however long you want to space your payments out. But that car note, it is a specified amount each time, and that's basically what this example is, except for a note receivable. Remember, we are the people that the customer is signing that note with. So the customer will be paying us because a receivable is an asset. Okay? Then it also says notes may be used to settle a customer's account receivable. Notes and account receivable that result from sales transactions are sometimes called trade receivables. So generally the scenario is a customer comes in and buys something from us. They buy it on credit, and we give them 30 to 60 days to pay us back. They come in at some point during that time frame and say, I would like some additional time to pay this back, and we would transition that account receivable into a note receivable. So we would require them to sign a sheet of paper, a formal agreement that says, I get extended time to pay this back, but I'm going to owe a certain interest rate along with this amount that I owe back. Okay, then there's also other receivables that we're not going to spend a lot of time talking about, but they include interest receivables, taxes receivable, and receivables from officers or employees. Those all would be reported on the balance sheet. They're all going to be reported separately because they're different line items. And just like accounts receivable and notes receivable, if they're expected to be paid back within a year, they're considered short term. If for whatever reason they are going to carry over for longer than a year, then they would be non-current or long term. Okay? All right. Now, when we deal with customers that we are extending credit to, there's always a risk involved. So when you allow a customer to come in and buy something and allow them to buy it on credit, there's a risk involved. And what is that risk? The risk is that you will never be able to receive that payment from that customer. Okay? They could move within 30 days. You couldn't track them down. They could claim that they don't have the money to pay you back. There's always a risk that you will not receive the full value that you're owed when you allow customers to buy things on credit. All right, so right here, so it says in prior chapters, the accounting for sales of merchandise or services on account was described and illustrated. So we looked at that in chapter 6. Okay. One of the major issues that we haven't discussed is that customers sometimes choose not to pay their accounts. And when that happens, a receivable is considered to be uncollectible. So if we have a receivable that we are owed by a customer, and that customer chooses not to pay us back or lacks the ability to pay us back or for whatever reason never pays it, that's considered uncollectible. And we have to figure out how to account for uncollectible receivables. And that's what we're going to spend the rest of the chapter on next week, is looking at the different methods that we will use to write off uncollectible receivables. All right, so there's a couple of different ways that companies handle this. So some companies want to keep this in-house. And if a customer either chooses not to pay, misses a late payment or two, company can't get in touch with them, sometimes they will choose to try and physically find that customer themselves, and then try to get that money that way. Or there are credit agencies that companies can sell their uncollectible receivables to for a certain amount, and then that credit agency has the ability to go and try and recoup that full balance. So basically, say that we have $100,000 in uncollectible receivables. All right, and so that's $100,000 that we don't expect to receive. Well, we could sell that to a credit agency for, say, $40,000, and then it's that credit agency's job to try and go get the full $100,000. Well, you might be thinking, why would we give away $100,000 worth of accounts receivable and only receive $40,000 in return? Well, the company may not want to spend all the time and the resources that it would take to track down those customers. So they would take the $40,000 and consider that much better than zero, and then allow the credit agency to try and track down those customers and figure out how much they're going to get. So that's some things that companies do when they have uncollectible receivables. Okay. So regardless of how careful companies are, so you can do background checks, you can do credit checks, you can do any number of things to try and vet a customer, but there's always the potential that some of your credit sales are not going to be collected, and companies know that. They understand that all of those credit sales will not be collected, but they choose to offer them because they open themselves up to much more business by allowing credit purchases. Okay, so how they treat this is whenever an uncollectible receivable is written off, it goes to bad debt expense. And that's something that we're going to look at next week when we get into the different methods. But we just want to introduce that term. So bad debt expense, right? It's where we write off uncollectible receivables. All right, so there is no general rule for when an account becomes uncollectible. Some companies base it on that the receivable is past due. So if you give somebody 60 days to pay it and it gets past that 60th day, some companies might choose to immediately write it off. Some companies may want to wait 120 days, 180 days, et cetera, based on how much they want to risk. If the customer doesn't respond to your attempts to collect, if the customer files for bankruptcy, if it's another business and they close their business, or if you can't locate the customer, those are good signs that that receivable is going to need to be written off. Okay. So there's two methods that we're going to introduce that companies use to account for uncollectible receivables. And they're called the direct write-off method, which I'll highlight right here, and the allowance method. Okay, so the direct write-off method is used by smaller companies when they have a small accounts receivable balance. The allowance method is used for larger companies that have a tremendously large account receivable balance, and it would take them longer to go through and try and find every individual customer that's uncollectible. So instead, they use an estimate and they write off a percentage. Okay, so the direct write-off method is often used by small companies and companies with few receivables. All right, so a big company like Apple, a big company like Best Buy, like Walmart, like Target, all the large companies that we know, they would not use the direct write-off method. So when we think about the direct write-off method, we want to think about a small boutique maybe that has very few customers that buy things on credit, and the owner would easily be able to look at their account receivable balance and see, hey, John Doe, he's 3 months late on his bill. I bet I'm not going to receive that. So I'm going to write his off. Whereas if you take Apple, who might have 10,000 customers that buy things on credit, it would not make sense for them to go through that entire list of their accounts receivable, and try and figure out who's not going to pay them. So instead, the larger companies use the allowance method and they estimate uncollectible accounts. Okay? So the direct write-off method records bad debt expense only when an account is determined to be worthless. Contrast that with the allowance method, and that the allowance method records bad debt expense by estimating uncollectible accounts at the end of the accounting period. Okay? So the direct write-off method is often used by small companies and companies with fewer receivables. That's what I already said. GAAP, generally accepted accounting principles, require companies with a large amount of receivables to use the allowance method. All right, and we're going to get into kind of why that is. But we're actually going to get into that next week. So I'll give you a little preview of what we're going to look at next week. So the direct write-off method so we're talking about uncollectible receivables. So this is a receivable that we have deemed we're never going to collect. The direct write-off method writes it off one way, and the allowance method writes it off another way. So before next week, I want you guys to read through 9-3, the direct write-off method for uncollectible accounts, and 9-4, which is the allowance method for uncollectible accounts, and then 9-5 and 9-6. Okay, so those are the things that we are going to talk about next week. Those are things that we'll talk about in class. And like I said, I do not anticipate us having class in person on Thursday, but for Group A, this lecture will serve as our class for tomorrow. So I'm going to put this up as an assignment. You guys will watch it. You'll let me know when you've finished. For Group B, you will simply do your attendance assignment tomorrow, and then I will fill you guys in on Thursday as we get closer. Okay? Hope you guys are staying safe. I hope you're having fun in the snow. Make wise decisions, and I will see you guys when we get back to class. Have a great day.